Debt to equity is a formula that is viewed as a long-term solvency ratio. It is comparison between external finance and the internal finance. Hi guys, myself Nitin Pava. Here we are going to have a discussion regarding debt to equity ratio. Before start, please click on a bell icon button to subscribe my channel. Yes, here I start first with a theoretical definition. Debt to equity ratio. Debt to equity ratio is calculated by dividing the shareholder equity of a company to the total debt which reflecting the overall leverage of a company. Again I am reading. Debt to equity ratio is calculated by dividing the shareholder equity of a company to the total debts which reflecting the overall leverage of a company. Yes, by using a debt to equity ratio, the investor get to know how a firm is managing in a capital structure and also to know the solvency as a company. When an investor decide to invest in a company, they need to know the approach of a company. Let's have a look at the formula. Debt to equity ratio equals to total liability divided by shareholder equity. In the numerator, we will take the total liabilities of the firm, and in the denominator, we will consider the shareholder equity. As a shareholder equity, we also included the preferred stock. We will consider also that. In the next slide, here we are comparison with the two companies, company A and company B. Now let's evaluate the debt equity ratio between these two companies. A company A where the total liability of business loans is 1 crore and shareholder funds is 20 lakh rupees. Here we are computing a debt to equity ratio by applying this formula, total liability divided by shareholder equities, which results to 5. And the company B where the total liabilities is 50 lakh rupees and the shareholder fund is 1 crore, and here the debt to equity result is 0.50, which means where company A is high levered and risk investment company and a company B a low risk company and a better investment. Means if the total liability of a company are higher compared to the shareholder equity, the investor could think whether to invest in a company or not, because having too much debt is too risky for a firm in a long run. If the total liability of a company are too low compared to the shareholder equity, then investor would think twice about investing in the company, because then the company capital structure is not conducive enough to achieve the financial leverage. However, if the company balance both internal and external finance, maybe investment would feel that company is idle for investments. Because of this ambiguity, some of the accounts in the primary balance sheet categories, analysts and investor will often modify the debt equity ratio to the more useful and easier compare between different companies. Now let's we understand the ambiguity first. Let's take an example. Imagine a company A with rupees 12.50 lakh in a short-term debts like wages, accounts payable and etc. and the 50 lakh rupees are long-term debts. Compare with the company B with a 50 lakh short-term debts and 12.50 lakhs in a long-term debts. In the both the company having a 62.50 lakhs in a shareholder equity, then the both having debt equity ratio would be a 1. Yes, would be a 1. On the prima facie, the risk from in the prima facie we can see the risk from the leverage is identical. Yes, but in reality, a company A is riskier. Now you are thinking how to evaluate the solvency. Yes, it's a good question. A common approach to resolve this issue is to modify the debt to equity ratio into a long-term debt to equity ratio. An approach is like help an analyst focus on important risk. Yes, we will study a modified debt to equity ratio. Before evaluating with an example, let us understand the few points. A few points will be, as a generic rule, short-term debts tends to be cheaper than a long-term debts and less sensitive to shift to interest rate. The next point will be, if interest rate falls, long-term debt will be needed to refinance, which can be further increase the cost. Rising an interest rate would seem to be favor the company with the more debts or long-term debts. Yes, but if a debt can be redeemed by the debt holders, it could be still be a disadvantage. On the other side, investor would need to compare a company's short-term solvency, have to evaluate the liquidity ratio like a cash ratio, current ratio, etc. Yeah. With the same illustration, we need to eliminate. Here you can see with the same illustration where we have a short-term debt 12.50 lakhs and a long-term 50 lakhs, and the company B, a short-term will be a 50 lakh and long-term will be a 12.50. Here we are eliminating a short-term debts, and we are we are computing debt to equity ratio long-term debts divided by a equity shareholder fund. Yes, here the end result will be the debt to equity ratio of a company A is 0.80 and the company B is 0.2. Here you can find the company A will be a more riskier. Yes. Now here some few limitations are also there. The limitation will be, see, the limitation will be when using a debt to equity ratio, it is very important to consider the industry within which the company exists, because a different industry having a different capital needs and growth rate. A relatively high debt equity may be common in one industry. Meanwhile, a low debt equity may be common in another. For example, a capital intensive industry such as auto manufacturing or a construction companies tends to have a debt equity above 2, or a technology or service firm could have a typically a debt equity under 0.5. But in a normal situation, a ratio 2 is to 1 is considerably healthy. From a generic perspective, youth company could be used a little more external financing and it will be help them in accessing the benefit of financial leverage. Yes, here it is a debt to equity. Now let's conclude. In debt to equity ratio, we cannot study in an isolate manner, means we cannot study a debt to equity as an individual. Debt to equity ratio compares a company's total liability to its shareholder equity and can be used to evaluate how much leverage a company is using. The next point will be higher leverage ratio tends to indicate a company with the risk to the shareholder. Debt to equity ratio cannot compare across the industries. Yes, we cannot compare it across the industry. It can be compared within the industry. Yes, as we previously discussed. Investor will often modify the debt to equity ratio to focus on long term debts only, because the risks of long term liability are different than the short term debts. Now the formula will be the long term debts divided by a shareholder funds. That will be the long term debt equity ratio. That's it. Thank you. Please subscribe this channel and share with your friends.